Thank you for tuning into the Buyer's Guide podcast, where we continue to talk all things property and finance. My name is Peter Mastriani. I'm the founder of the Buyer's Guide, and in today's cast, I want to have a bit of a discussion about social trends and how our changing society is going to basically impact our future investment decisions. Now, this topic sprung to mind when I actually received a letter last week, as did almost everyone else, from the Australian Bureau of Statistics on next week's census. Now, my inner geek claps with excitement on the anticipation of new data. I know it's this strange peculiarity that I have in regard to a love of stats, but I thought it would be worthwhile making some comparisons, and it might give an interesting topic and rise to a couple of comments. So, let's get to it. My grade 9 maths teacher would regularly start off his classes by saying, "Boys," he would really try and highlight that S. "Boys, important lesson today. It's important because girls love mathematicians." Now listen up. Okay, so perhaps it was from these grade 9 math lessons that maybe spurred my interest in numbers, naively believing that girls actually did love mathematicians. As a 14-year-old boy, like every 14-year-old boy, I guess, I wanted some loving. Problem was, though, that I was an average C, B grade type student in both of those departments, actually. Anyway, look, I guess a lot has really changed since I was 14. It's actually sad to say that that's almost 20 years ago now for me. The last time that we actually had a census was 5 years ago, in 2007. And a lot has changed in the last 5 years. For me, look, God, geez. In the last 5 years, I've traveled extensively. I've bought, renovated, developed, and sold property. I've changed jobs. I've changed careers. I've gotten fired. I've started businesses. I've gotten married. Kids are coming on the way. It's been a pretty busy 5 years. And imagine trying to calculate the stats on any number of those aspects, because like me and everyone that's probably listening out there, I'm sure everyone's had a pretty busy, chaotic 5 years. So putting all that together and, analyzing it like the Rain Man or John Nash, it's their dream. I'm sure the peeps down at the Stats Bureau, they're all on tenterhooks in anticipation for this new data to come in to, determine what social trends have taken place and what the expectations would be for in the future. So I guess when it comes to property finance and general investment, what can these trends actually tell us, and how can we actually spot opportunity for investment in the following 5 years or the preceding years thereafter? So I thought it'd be worthwhile taking a look at some of the key indicators back in 2011 to now. Firstly, interest rates. In 2011, interest rates were roughly around about 7.6%. In November of 2011, the RBA actually cut rates for the first time in 31 months. Today, we're anticipating that the RBA is going to make an announcement for a further rate reduction. And at present point in time, you can probably get a pretty decent rate for around about 3.8%. Now, that's almost 4 full percentage points lower than what it was 5 years ago. It's crazy. Now, the stock market, in August 2011, the All Ords floated roughly around about 4,300, 4,400. As of today, the All Ords are around about 5,600. So in the past 5 years, shares really haven't done too much. They've climbed to the mid-fives, they've dropped back a bit, they've come back, they've been up and down. It's a bit boring. Anyway. Average property prices, though, this is pretty interesting, because back in 2011, Australian house prices had actually plunged by the most on record in 2011 as, global economic uncertainty and concerns about its impact, really kept a lid on demand, which subsequently put price increases on the back burner. 5 years later, data from the last housing price report shows that property prices have continued to rise in most state capital cities. Sydney's still surging. So is Melbourne. Brisbane, Perth and Darwin, they actually declined last quarter, but overall in the past 5 years they've still done pretty well. On a quarterly basis, Sydney prices have jumped 5.6%. It's massive. Melbourne was up 3.5%. Sydney has now been going through a boom cycle for about the last 4 years. Australian dollar, 2011 was around about 110 cents. People were cheering. Overseas holidays were an absolute must. Like I said, I travelled extensively in that time. Now they're around about 76%. And when I went on holidays with my wife last year to the States, it definitely hurt. Unemployment, 2011 was around about 5%. 2016, it's around about 5.8%. Now, back in 2011, markets were jittery. In 2016, there's still a lot of pessimism about, markets are still feeling a little jittery. However, there are opportunities for investment, and they're around aplenty. I guess if you're in 2011 and you invested in shares, you probably wouldn't be too impressed. If you actually held your money in cash, it's probably gone backwards. If you invested in Melbourne or Sydney property, you'd be high-fiving and patting yourself on the back. In the past 5 years, the baby boomers, they're starting their transition towards retirement. Their major theme for the next 5 to 10 years is going to be the preservation of cash to fund their retirements. They've topped up their self-managed superannuation funds with property. They've made some gains, and they're probably going to start applying the brakes soon enough. The major theme that I foresee is the rise of Generation Y. Gen Y, which includes myself, is now going to become the dominant generation in society. Us Gen Yers will realistically be the largest consumers as our spending cycle in terms of our lifetimes is going to start to peak. We're all moving towards marriage or kids or houses. Some might be further away than that than others, but this is what will start to happen, and with that becomes more stuff that you need to buy for your house and the ongoing spending to maintain your household and to provide for the family, etc. We're going to be forking out a lot of cash in the years to come, as a generation, that is. Now, another important factor to highlight is, at the moment, the average age of an Australian property investor is actually 34 years old. And according to the Domain Consumer Insights study, the average age of a Gen Y Aussie to become a property investor is now actually 25 years old, whereas the Gen X's was 35 years and 45 years for the baby boomers. In addition, 16% of Gen Ys own 2 or more properties, compared to 17% of baby boomers or Gen X's. Interestingly, though, 75% of these investors actually earn less than $80,000. So I feel the numbers actually speak for themselves. Property investing is no longer exclusively reserved for the wealthy, albeit that property prices are continuing to rise. So whilst there's a lot of rhetoric around affordability, and don't get me wrong, it most certainly remains a compressing issue for parts of society, people are still buying property, and in younger generations buying increasingly more of it. So that just goes on to say, these people are coming from all walks of life. They're opting to invest in property in more affordable areas and live where they want to live. When the Buyer's Guide launches www.rentvesting.com.au in the coming months, it's going to be at the forefront of demonstrating how you can actually build the largest asset base you can with the money that you can actually afford. If you actually look at the current data around first home buyers, you'll see that it shows that there's actually dwindling numbers quarter on quarter. But what the stats don't actually show is how many first home buyers are actually investing first, which I personally believe will probably skew those stats quite significantly. In most capital cities, Look, there's been a boom in construction, particularly of apartments. Anyone can see that. Everyone knows that. And, most people indicate and feel that there's an oversupply. And yes, in some areas there are. However, what many people don't actually realize is that building approvals and lending to this space is increasingly getting tighter. I believe we're going to actually start to see these numbers actually dwindle fast. These apartments have sprung up because it's now increasingly more acceptable to live on your own or with your partner. 1 and 2 bedders have popped up everywhere. Society is changing and people are wanting to be linked closer to where their lifestyle needs are going to be best met. I believe that the risk isn't actually in the oversupply aspect, because the market in time will absorb the supply. I personally believe that the biggest risk for potential investors that they face, particularly over the short to medium term, is probably more a timing risk than anything else. That the market moves in cycles, which means that there's going to be opportunities or times to actually exploit and times to sit on your hands. And smart investors know how to mitigate their timings, which comes back to, getting your research right. Now, as a mortgage broker, personally myself, one of the biggest issues I actually foresee is probably around regulatory issues. Lenders are changing their policies relating to their loan-to-value requirements. They're tweaking their interest rates and they're tweaking their policies around investment lending. Interest rates are really going to be a good one to watch, because whilst they're continuing to drop, whilst they're at historical lows, there's still a lot of people out there that are over leveraged, and any upwards movement in rates is really going to hurt some household accounting budgets. Now, when it comes to next week's Census 9, I'm going to be a pretty keen participant. I'm keen to see what numbers are going to come from it. Looking into my own crystal ball, I'm going to be so bold to say that I see a few things actually taking place. Firstly, bubble bursting. In property, I don't actually see it. The market is cooling its jets, no doubt about it. But I think a collapse is pretty unlikely, unless, of course, there's some sort of economic Armageddon that happens. And look, I think that's pretty unlikely as well. Australian property has, for a very long time, been pretty strong and a steady performer, which I personally feel won't change, at least for the foreseeable future, until the next census or the next one thereafter rolls around. Demand. Look, as I said, there are some aspects of oversupply in some areas, but you have to realise we're an ageing population and we are becoming a bigger Australia. And I truly believe that oversupply will quickly change to undersupplied. There's almost 5 million residents in Sydney. It's tipped to be around about 5 million by the end of the year, and Melbourne isn't too far behind that number. When Ruddy first talked about a big Australia back in 2009, the population was around about 22 million. And the 6 or 7 years that's since passed, it's jumped by 10% to 24 million. It's expected by the middle of this century that the population is going to be closer to 40 million people. In turn, that's going to put pressure on infrastructure, and there's going to be a genuine need to have walkable urban communities, and apartment living is definitely going to be in favour. Looking into the crystal ball, I see affordability. I still see this to be an issue, and people looking to get into the market or investors will certainly be chasing this as a key requirement. Brisbane and Melbourne at present, they offer a really good combo in terms of those middle rings, because they're reasonably close, they're really well connected to infrastructure and employment nodes and communities. And I think there's going to be an increasingly strong demand for these types of areas over the next 5 to 10 years, based purely on affordability. I still feel that prices will be high compared to income ratios, and I don't foresee that changing for some time to come. Still looking at the crystal ball, I think that we're going to become even more connected from a technology perspective. There's going to be better games than Pokemon that'll be developed for our phones. And importantly, for the next generation of investors, the generation Y, in the next 5 to 10 years, we're going to become the business leaders. The startups that people are working on today are going to be the enterprises of our future, in the next 5 to 10 years to come. We're going to place more of an emphasis on lifestyle and look for more meaning in what we do. Rentvesting as a way of life will become a growing tribe, and one of which that the Buyer's Guide certainly intends to cater for. New household groups are emerging, and the nuclear family will remain, but there's going to be a strong emergence of new household groups, and that's going to have a direct impact on how we live, but also impact on how property is built, how it's bought, and also how it's sold. We have these changing demographics to thank for this. And if you plan on becoming a successful investor, becoming a rentvestor or pursuing rentvesting as a way of life to maintain what you actually want in life, whilst growing an asset base, as large as you can with the money that you actually can afford, then I personally believe you need to be keenly attuned to how, as a nation, we're actually changing. So bring on the census, and maybe in another 5 years I'll do another podcast or write another article to reflect on what I've actually said and see if I actually got my crystal ball gazing correct, see if it's actually come true. So look, I guess that's it for another episode of the Buyer's Guide podcast. If you like the topic and want to know more about rentvesting and joining the tribe of investment accumulators, then watch out for www.rentvesting.com.au. It will be going live in the months to come. Now, be sure to also subscribe through to this podcast here, not to miss out on any future updates on this topic, and stay ahead of those social trends that come about. But until next time, bye-bye.